Their website is thefinancialguys.com. They have financial advisors registered in 33 states, by the way. You can call 833-FIN-GUYS. That's 833-FIN-GUYS. And they're available on all social media outlets, just like Chris Collins is. Mike Lomas joins us, along with John Thur of the Financial Guys. How are you, gentlemen?
Awesome. And I brought John Thur on. David, he's one of our lead portfolio managers. I always say he's the smartest guy in the room, and you deserve the best, right? So I know you're going to ask us about GameStop, but I'm going through it with John. I'm like, John, why don't you just come on with me? You're one of the smartest guys. David deserves the best.
Well, we have our own sound effects for John Thur. I appreciate that. Could you just give us the breakdown of, because one of the things you guys do at the Financial Guys is you deal with people that have an extensive knowledge of how the stock market operates. You deal with people that have no idea how the stock market operates. It's all really dependent on your comfort level. Are you aggressive? Do you want to go long term? How do you look at the world? When we look at the stock market in particular, this is about volume. We get prices based on volume. Nobody looks at a company and says, these guys, they're really good at what they do. They're consistent. They've been here for years. If nobody is buying the stock, the price doesn't go up. It's not evaluated based on anything other than how many people are interested in purchasing the stock.
That's true.
That's pretty much correct, David, and that's the kind of market we're in right now. But where the homework comes in and helps is if you can buy things that are participating in here but have strong fundamentals, you help yourself when it goes the other way. And that's what we kind of try to do, is participate but protect.
As you know, David, we talk about, this is the place where money meets politics. And when you look at the last, really, since Biden's been in office, we've had a market pullback. And people are saying to me, why is that market pulling back? And I'm like, well, number one, Biden's climate control measures, right? We all know, doesn't it sound a lot like the Cuomo New York State climate control measures? Let's put windmills in that don't work. Let's give money to bankrupt solar panel companies so we can have vacant warehouses. Let's waste all kinds of taxpayer money, and the stock market is pricing that in. It's also pricing in the fact that day one, Mr. Biden wiped out 70,000 of pipeline jobs, and now we're looking at higher fuel prices, which is specifically a tax on the poor and the middle class, right? And we're going to see fuel prices continue to rise as we do less drilling, less exploratory measures to find alternative fuels, and they think that everybody's going to drive around and I guess bicycles or whatever. But and then of course he increased minimum wage, so we're going to have less jobs there. So the market has been pricing this in over the last week. I know when you called me earlier, you wanted to talk specifically about GameStop and what happened there, and that's why I wanted to bring John in, because you're seeing a lot of market manipulation, right, John?
Yeah. What I'd like to do, David, real quick, is give you the 10,000-foot view, and then we can break it down as much as you'd like. And what happened here is it's basically, I call them cowboys or renegades. They're out there on the system. They use Reddit and other social media financial websites, and I'm sure they're going to move around now where they can't so easily be detected. But they did this boldly and in public, and it was a vengeance kind of thing against institutions. It's a stand up and say, here's in your face. Because what happened in '08 was a lot of this stuff was going on in '08, and it blew up. And it was based on leverage and using options markets and futures markets and a lot of different financial instruments. And these guys saw an opportunity, and they're saying a lot of these guys at the time were kids, young teenagers, whatever, and saw their parents lose everything. And they saw the institution guys get bailed out, and they're mad. And they said, look, GameStop's got 140% short position. Now, that doesn't make sense. How can you be 140% short?
And just to explain to people, John Thur and Mike Lomas from the Financial Guys, when you short a stock, you're basically you're putting money into the fact that it's going to lose money.
Well, yes, and we'll go into all this, but I'm going to give you the real quick rundown of the summary.
Okay, sure.
But what happened was they said, here's our chance. And what they did was, and they squeezed them. By that I mean they went out and they bought a lot of options, a lot of calls out further. And what that did was a trade. The guy who makes a market in these, the guys who make a market, need to build their book in defense of what was going on. So they have to go buy shares. Now the guys who are short, which means they've sold it and they don't own it, and they're betting on it going down, they're watching this. And they're starting to see it move away from them. And this is a stock who's supposed to go down and out of business. And they're like, what's going on? Well, now they're getting scared. Now they have to go in and cover. Well, when they go in and cover, there aren't enough shares left. These guys have accumulated and leveraged it with options, and now they're scared and they're panic buying. And it's driving the price up. And now people figure out what's going on, and these are hedge funds that are getting squeezed. And basically it was an in-your-face kind of move to say, you're going to get your due, and this is it. And that's what the summary of really what happened. And now to answer your question about short. What a short is, David, when I don't believe GameStop's going to survive, let's say. Or even I just think it's IBM that I think is going to go down 10 points. And I want to take advantage of that. I will sell IBM, and then wherever my assets are custodied, it's a short, so I have to have a margin account. And basically, I'm borrowing, not money, but I'm borrowing stock. So you have IBM, they take it out of your portfolio, put it in mine, and deliver it on my sale. Now I'm short IBM. I don't own it. So I've sold it, but I don't own it. When the stock goes down 10 points, I go in and buy it back, and they replace it in your portfolio. Okay? And I made money when a stock went down. That's what a short sale is, basically.
So I guess my argument here is that in this environment where we're censoring people for their political ideology on platforms, in the environment where the little guy wants to get together and compete against Twitter and Facebook and starts, Parler to compete against all these big juggernauts, and they're destroyed. When a bunch of little guys, they might have, more nose, like they fell into a tackle box. They have so many piercings in their face, green hair. They're out there and they want to strike against the hedge funds. Their argument is, well, hedge funds arbitrarily pick and choose their winners by throwing their money into different companies, artificially inflating the market. Why can't we, on an app like Robinhood or these TD Ameritrade apps where anyone can essentially make and choose and buy and sell stocks on their phone, why can't we artificially inflate the market? Why is it that when a bunch of millennials decide to do this to save their beloved GameStop, it's then, the market steps in and says, you can't trade this anymore. We're taking this off the app. You can't buy stocks. Only Warren Buffett can do this. Only the hedge funds can do this. You little guy, you can't do this.
That's basically what they're saying is we're pushing back. And, there's a guy who got on and was so excited by the money he made. He told everybody he was able to pay off his full student loan. I mean, these people are a different generation, and they are speaking out, and this was kind of their protest, to say, in your face, look what you did to us in '08, how many people lost jobs, how many people lost homes, how many people lost their lives, and you guys got away with it. And guess what? We're squeezing you now in your face. And that's kind of that's why I call them cowboys or renegades or, they're not bad people. And I don't want to paint a picture, David, that these are people sitting there with the green hair and the green.
These are professional traders.
These are probably PhD math majors. These are guys who are geniuses that don't fit in to an institution because they're too damn smart, okay? And now with the tools, the equipment, I can do my job, David, from anywhere in the world. As long as I have my computer, my phone, and I can do it with everything in the cloud, I can do my job from anywhere. So these guys who start small and do some good trading and get some capital built up, build their own businesses, they're worth millions, and they've got other people that they do this for now, and they are controlling more and more of the market. So they're not just some, typical retail guy, mom and pop some kid playing in his basement. These guys do this for a living, and they're very good at it.
Yeah, they don't have the nose piercings and the blue hair. These guys are pros, right?
And with the politics in some of these
I must have been referring to Lomas in particular when I was saying that. No, but Mike, let me ask you, the financial guys, by the way, thefinancialguys.com. You can call them at 833 FIN guys, FIN guys. They've got advisors registered in 33 states. Anywhere you're hearing this show, you can call or reach the financial guys. You know, you look at what you do for a living. John Thur, obviously a genius at what he does. How do you not look at this, though, and say, you know, everything's virtual? Our money is virtual. Wall Street used to need to be in New York City. It was the center of the financial capital of the entire world. It's really not. It's not even, it doesn't need to be a location. Wall Street is virtual. Money is virtual. This can happen from anywhere. John was talking about people, you know, literally doing this at their kitchen table, trading stocks. How is it that we look at this? It's almost in the same breath that we're looking at everything else, where the big guy, people in power, can then look at little guys and say, you're not a part of our club. You're not allowed to talk the way you want to talk. You can't assemble because you're not part of our club. You're not allowed to do the things that everyone else is going to do. And now when it comes to making money, we're afraid that little guys now run around and do this to all the stocks, that are available on NASDAQ and the Dow. How do you control that? And how is this any different than the censorship that's going on in social media and in the media in general?
Well, before I pass it up to John, let me just say that this has been happening forever, right? From the beginning of the stock market. Now with information and social media, it happens faster and bigger. John, you used to say they would have old school dinners, and the dinners would be a bunch of, old guys getting together that would say, hey, how are we going to manipulate this stock? How are we going to move this market? And at the time, that dinner might have had 10 or 20 people. Now the dinner has, 300,000 people, right? And they're showing up on social media. So this is no different than it's always been. I will say from a financial planning standpoint, you always hear us talk about diversification, really key to do that. I'll also say where money meets politics, we have to look at what they've been doing over decades, right? And COVID has proved this, where they started to pick winners and losers, and the government, as it gets bigger and bigger, has more power over picking those winners and losers, right? So now, over the last 12 months, we've said, that's why I've said be very careful. People have said, the restaurant industry, salons, gyms, they're getting smashed. How in the world is the stock market going higher? Well, those are not publicly traded companies. The checks that those people write are not big enough to pay off all the Democrats in Washington, right? However, look at who's got money now, right? Amazon, Apple, Walmart. Guess who's writing the checks to the Democrat Party? And so, the publicly traded stocks have done exceptionally well here and may continue to do well because we're smashing all the mom and pops and forcing the money into that system.
David, here's what you want to take out of this. You brought up the best point is regulation. Now, let's see where this goes, because what these guys did and gals did in this situation by pushing back and being the cowboy, they've exposed the abuse that goes on. These hedge fund guys have been doing it for decades, and nobody's done anything about it. 2008 happened. They did not do much to eliminate this kind of behavior, David. So what they're saying is this is going to cause the market to melt down again, and we don't want it. So now they've exposed it, right? So who are they going to regulate, David? Are they going to come down on the hedge funds and say, you can no longer lever 10 to 1? Or are they going to come down on these guys for exposing it? You see what I'm saying? This is what we need to watch and see.
Well, I think we have our answer already.
What's that?
I think we have the answer already. I think they've already decided who they're going to crack down on. And, one of the things that I'm so fascinated by the way you look at the market is these are opportunities where, you're thinking you're retired, you're looking at your 401k, the last 4 years, just unprecedented growth. You're super excited. You've got a lot of time on your hands. Maybe you're doing more and more in the market on your own, maybe relying less on the professional financial planners and doing your own thing. And you see something like this happen, and your instincts are, I've got to ride this wave. I want to be a part of this. and you can find yourself really just completely getting into a position where you're over leveraged and losing money and going a little bit crazy. Sometimes, when you have too much time and the accessibility to do things outside of your comfort zone, you treat the stock market a little bit like a scratch-off ticket.
Yeah, absolutely. And it's exactly why we've divided our firm up. And John is a chartered financial analyst. And I always joke and say he spends most of his day not out talking to people, sitting in front of the computer. I'll say we don't let him out of the office, but he's literally in front of his computer all day. I'm in his office right now, and he's got a list of stocks in front of him, and he'll do research all day, not only on stocks, but on money managers we're using. It is absolutely imperative that you're doing the research right now to understand what you own, now more than ever, because some of these people are going to get burned by this stuff. That's what happens, right? I mean, the stock market's an exchange. There's buyers and sellers, and at some point, the sellers start to come in and dump these folks that thought they were going to get rich quick. So you really have to do your homework to make sure you understand what's in your portfolio.
I'm going to tell you a quick little story here. This morning at around 6:30, I get a text. It's one of my clients. She's a retired teacher, and she says, "Hey, John, do we own any of that GameStop?" So when you
everyone's on it. Hey, John, let me ask you a question. With interest rates almost invisible at banks, the old days, you could get a checking account at 2%, savings accounts, money market accounts. Interest rates are so low that people have completely, there's a new realistic approach to putting money in the bank and the growth of money just sitting stagnant in an account. We look at the stock market as a way to, get a return that you used to be able to get maybe with a CD, maybe, just throwing it in a bank, a savings account. What is a realistic return? I think we watch the movies where people shorted the housing industry. We hear all these stories all the time about, 80% returns on investments, and you get in and you get out really quick. The realistic approach of, how someone should look at the market and the return, when it's almost impossible to look at returns and compare them to interest rates and what's happening in banks today.
Here's the way we look at it. I'm a risk-based manager. I look at risk first, and then I decide if I'm getting paid enough to take the risk. This business is a business of probabilities, statistics, and reversion to the mean. When you have a market like this for the last 10 years just going up, 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 and it's because of the Fed and the central banks around the world keeping interest rates anchored at zero artificially, not that they deserve to be there, and saying we're going to raise them when inflation starts coming back. There is inflation. It's in the hard assets when you do this. It's in the stocks. It's in the bonds. It's in the automobiles. It's in the homes. Now, when you have banks lending people money, for a home that they just paid 30 or 40% more than what it's really worth, and they're allowing them to borrow 95% of that value, what happens when interest rates rise and the value of the home starts to go down? Those loans are all going to be underwater. Aren't we right back in 08?
Right.
Creating more problems with these low interest rates. But the other problem, David, is if we don't have these low interest rates, if you just do a scratch pad number, government's got $27 trillion worth of debt. If the interest rate's only just 1%, is that $270 billion? That's a quarter of our annual deficit. So what if rates were to go to 3%, which is probably lower than they should be? You've just tripled that cost of borrowing. So you got to look under the covers here, and there's a lot going on to be cautious about. And I tell people, if you have any large sum of money, you need to get a professional, and you need to have a portfolio designed with a risk that you can understand and that you can live with, because this will not go on forever.
And to further that, David, many investment models, and that's what I work on, the overall asset allocation models, have really sort of been forced to change. I mean, when I started in the business 20-something years ago, I could take half of somebody's money and go out and buy a 6-7% CD with it, right? And it would generate some income for them to live in retirement. And obviously that's not the case anymore. So you see many firms that are, moving assets from these conservative buckets to a more risk-adjusted basis to try to go out and catch yield. And so at some point, we just say you got to be careful. It doesn't mean, by the way, and I don't want anybody leaving here going, no, I'm going to sell this or buy that. It just means you understand what you own, and you've got a proactive plan in place, and when stuff pulls back, you also have a plan to be able to take advantage of it.
But some of the other things we're doing, David, there's the public market that we all know, but there's a private market out there, and that private market's been growing the last 20 years, and that's where I'm starting to go on the fixed income side and on the equity side, really, because this market's just gotten out of control, whether risk-reward-wise. So,
well, listen, you guys, this is just incredible. I mean, first of all, Mike Lomas, give John Thur a vacation. This guy's thinking way too hard. His brain is immense. He needs a PlayStation 5.
But
he's doing great. Listen, thank you so very much. John Thur, amazing intellect. Really super, learned so much from you. Mike Lomas, as always, The Financial Guys, thefinancialguys.com, 833-FIN-GUYS. They are all over the place. They got you covered. And they have a show on the weekend on Saturdays right here on WBEN. I appreciate you. Thank you for your time. Thank you for your education. My goodness gracious, my brain is full.